We had the very lenient frat house mom in Janet Yellen, and it's been replaced by a dude who's reputed to be a little more strict. So it sounds like things are going to be different at the Fed, but I mean, quite frankly, I mean, liquidity's been draining out for a while. We've focused on, I mean, almost no one looks at the money supply numbers anymore. I grant you that. The emphasis is on the size of the Fed's balance sheet, but M2 growth for the first time in 7 years has slipped below nominal GDP growth. So think about it. For 7 years, the rate of money supply growth was faster than what the real economy could put to work. And that all flowed in, we think, into financial assets. Certainly explains a lot of the stock market boom. And it's all, you know, it's changed at the margin. And finally, the last couple quarters, that year-over-year rate of M2 is now below the GDP growth rate. I mean, that's just one of many monetary measures we're seeing that are deteriorating.
And you point out the Russell and some of the other more speculative areas that have been leading the market higher. And you can say that's all fine and good until it's not. And then it can turn around quickly. Are you seeing that that's a concern for you?
It is. I mean, quite frankly, the leadership is not what we expected this year. I wouldn't say the market, I mean, in technicians' parlance, I wouldn't say it's undergoing like a classic distribution where small caps and sort of the average stock are lagging. But we do have a situation that's more disjointed where you've got the Russell and the NASDAQ up 10 to 12 on the year and the NYSE composite and the Dow roughly flat. I mean, that's very disjointed. It's not at all like last year where everything, I mean, even the laggards, I mean, value and small cap lagged by quite a bit last year, but they were all making new highs in concert. So that's what's very different. So we do think this tightening monetary situation is having an impact, just not quite in the way we expected as to market leadership.
Barry, you're in Xenia? Really?
Well, as we're looking at the market today,
Barry, are you in Xenia, Ohio? That's a simple question. You're in Xenia, Ohio? Really? You're just north of Cincinnati? Is that true?
Yes, that's very true.
Really?
Yeah.
You got a big election coming up. What's going to happen with that? Do you know tomorrow?
I do not know what's going to happen with it. And it is being closely watched around the country, so it will have an impact in the political world.
No, I know. Yeah, I know all about this. I remember it was years ago. He had a horrible tornado like 20 years ago. That's what I remember from. Well, you also are worried about tech to some extent, or at least most of the stuff you're writing about here focuses on that. Do you have the same view as Doug in terms of it being sort of a tenuous situation here, or are you more bullish?
Well, if we look at it from two sides, one side, the long-term trend is really good. We're within 2 weeks of an all-time long in the bull market, and you've got good earnings and a good economy. And that momentum that we see in the market is positive. On the shorter end of things, we're seeing that risks are really rising. If I can make the analogy of a ship, I was watching a shipwreck show last night. When you get into dangerous waters, you've got to be very careful how you're proceeding. And some of the reefs we see out there, of course, the Fed is doing quantitative tightening. We've got relatively high valuations on stocks. We've got trade wars. And all of those things together, any one of those could cause the market to slip. And certainly we've got the hangover, with Twitter and Facebook both running into some trouble lately, and basically a kind of a mania in that whole area. So if we look at this market today, we say the risks are high. You should be lower in equities, which is what we're doing with our Golden Rainbow Fund. And you should have a good chunk in bonds, probably not real long in those bonds, but that's probably the safe approach. And the one area that's been so ignored for so long that they're now invisible are value stocks. And we really think that's a place to be moving into.